global equity investors are having a much more pleasant 2019 than they had in 2018. But the one thing to keep in mind is that the returns have been very bifurcated. There's that difference between those that are less sensitive to the U.S.-China trade war and those that are more sensitive to the U.S.-China trade war. You can see that by the significant outperformance between the U.S. and Asia. If you look at the next chart, this shows you that just year to date, the difference between U.S. equity markets and the Asian equity markets is nearly 15% just this year to date. But there are several reasons why the U.S. has been the global leader this year. Taking the political uncertainty out of the equation, we have much better economic growth than a lot of the other regions. So this should translate into better earnings, and better earnings should translate into higher equity prices. And now we also have a very accommodative central bank. So you combine good growth, muted inflation pressures, and accommodated central bank, this supports the U.S. being the leader this year. So what we've seen this year, because of the strong performance of U.S. equities, that there are pockets of the U.S. equity market that are expensive. For example, U.S. large cap growth. While it did come into some volatility in the third quarter, it did not pull back enough for valuations to look attractive. Where we see more value is in the small and the mid-cap space, especially in the small and mid-cap value space. This area of the market has been left behind in this rally, but yet it stands to benefit from the fact that we think you're going to have at least positive economic growth, not contracting economic growth, and then a very accommodative monetary policy. These sides of the market, not only are they attractively valued, but they stand to benefit from some of the fundamental reasons as well. Now, when we look at the U.S. versus international, because of the big outperformance the U.S. has seen versus the international markets, you're looking at the international markets, again, extremely cheap compared to the U.S. If you look at this next chart, this just looks at the price of U.S. equities versus the price of global equities, excluding the U.S. And what it's showing you is that global equities, excluding the U.S., have never been cheaper in comparison to the U.S. equity market. Let's put that another way. International equities were not even this cheap compared to the U.S. equities when we were talking about the complete demise of the European Union. But what we have to remember is that there are factors that can fix these problems in the international markets. We've started to see some thawing in the tensions between the U.S. and China. If we get any kind of a trade agreement, a soft agreement, an official first phase, you will see that some of these growth indicators in these international markets will start to improve. That should start to help those international equity markets catch up to the rally we've seen in the U.S. equity markets. So because they're very attractively valued, we think that there's the potential for a fix from the fundamental side, that you should have a good allocation in the international markets over the U.S. markets. But when it comes to international equities, we cannot stress enough that selectivity is extremely important. Selectivity from the regional standpoint, but also managers that can selectively pick the appropriately valued stocks in these highly uncertain times. One of the regions that we do like is Asia. And I know everybody thinks, why would you like Asia when we're in the middle of a trade war with China? China is not Asia. Asia is a very big region. There's a lot of other countries that stand to benefit regardless of how these trade tensions end up panning out. If you look at the next chart, this just shows what we've seen from a trade perspective with the U.S. versus other trading partners. And what you've seen over the past year, that our trading with China has declined. Yes, we're in the middle of a trade war. That's expected. Look at some of those regions that have picked up that slack. These are emerging Asia regions. So we still like Asian emerging market equities. We recommend a modest overweight there, especially for our more risk-averse investors. So just to summarize in regards to global equities, we still like global equities, especially for our clients that have a solid risk tolerance. That's because we do not see a recession imminent, especially here in the US. We have a very accommodative global central bank policy. This is supportive of global equities. However, it's just as important as ever to make sure that you have an actively managed portfolio, not only from the regional aspect of the asset allocation, but specifically when it comes to those managers that can pick the appropriate stocks that are truly being priced off of valuations and fundamentals and not being priced off of momentum.